$6 trillion didn't vanish. It was redirected under a structural revision nobody announced. In the next few minutes, I'll show you three things. What instrument was used to force the repricing, why the timing locked into a debt rollover window, and what this makes unavoidable in the next settlement cycle. The headlines are calling this a correction. The private desks are calling it a liquidity extraction event. That detail changes the interpretation. What you saw in gold and silver wasn't sentiment turning bearish. It was a coordinated margin call executed through futures clearing rules that got amended 48 hours before the move. The mechanism sits inside the London Bullion Market Association's unallocated account structure and the way it interacts with COMEX contract rollovers. Here's how it works. Unallocated gold accounts don't require physical delivery. They're paper claims on metal that may or may not exist in a vault. When a clearinghouse raises margin requirements on those claims, leveraged holders face a choice: post more collateral or close the position. The clearinghouse raised requirements by 18% on a Friday afternoon. That forced liquidation by Monday morning. First, the margin hike hit the largest bullion banks holding synthetic long positions for institutional clients. These weren't retail speculators. These were pension funds and sovereign wealth vehicles using gold as a dollar hedge inside balanced portfolios. Then, the forced selling triggered algorithmic stop losses across the futures chain. $22 billion in notional exposure unwound in 90 minutes. Next, the selling pressure crossed into the physical market, but no corresponding demand appeared from jewelers or central banks. That gap confirmed this wasn't organic. It was procedural. After that, silver followed on a 7-hour delay, which tells you the pressure came from a shared funding desk, not from independent market participants reacting to news. By Wednesday, both metals had lost 14% from their 30-day highs, and volatility indexes spiked without any macroeconomic catalyst. But that's not the real pressure point. The real pressure point is what happened in the Treasury market at the same week. 10-year yields climbed 19 basis points while gold sold off. Normally, when yields rise, gold falls because the opportunity cost of holding a non-yielding asset increases. But that's a retail explanation. The institutional explanation is different. Rising yields mean the Treasury needs to issue more debt to roll over maturing obligations. To make that issuance attractive, competing stores of value need to be suppressed. That's not conspiracy. That's cost of capital management. Here's where the incentives show up. The United States Treasury has $4.3 trillion in debt maturing within 12 months. Rolling that over requires buyer appetite. If gold is climbing and offering an alternative to duration risk, that splits capital allocation. By forcing gold lower, the Treasury complex becomes the only liquid safe haven with yield. The timing is surgical. The Federal Reserve had just signaled a pause on rate cuts, which means short-term funding costs stay elevated. That makes rolling over short-dated debt more expensive unless demand is guaranteed. Suppressing gold guarantees demand because it eliminates the psychological competitor. Who benefits? The Treasury General Account, which needs to refill after a spending cycle that ran 12 consecutive months above revenue. The issuance calendar shows $600 billion in net new borrowing before the fiscal year closes. If gold stays elevated, foreign central banks diversify away from treasuries. If gold drops, they rotate back in. Who gets boxed in? Anyone holding unallocated gold through a bank that's now facing margin pressure from the clearinghouse. They either sell at a loss or inject capital they didn't plan to deploy. Most sell. That creates a cascading liquidation loop that feeds on itself until the margin requirement stabilizes. Who gets hidden? The entities that bought the dip. Physical gold purchases from non-reporting buyers spiked 22% in the 3 days after the crash. That's not retail. That's accumulation under volatility cover. What gets hidden is the separation between paper price and physical demand. The paper market sets the price. The physical market sets the structure. Right now, they're moving in opposite directions, which means the price signal is political, not economic. If foreign central banks interpret this as a suppression event, then their next move is to accelerate physical accumulation outside the COMEX and LBMA system. That breaks the pricing mechanism entirely. If leveraged funds stay sidelined because margin requirements don't come back down, then gold loses its reflexive bid during the next credit event. That removes a circuit breaker the system has relied on since 2008. If Treasury issuance continues at this pace without natural buyers, then the Fed has to step back in as the buyer of last resort, which re-expands the balance sheet and negates 2 years of quantitative tightening. That's the second-order effect nobody's pricing in. If you hold cash, understand that its purchasing power is now tied to whether Treasury auctions clear without central bank intervention. If they don't clear, rates spike, and cash gains relative value short-term but loses it structurally. If you hold risk assets, recognize that gold's suppression was a signal that liquidity is being funneled toward government debt, not private markets. That's a defensive posture, not a growth posture. If you rely on a paycheck, track the yield curve and unemployment claims weekly, because the funding strain that forced this gold move will eventually show up in corporate credit markets. And that's where hiring freezes start. The playbook here is not about predicting the next move. It's about recognizing the structure that's already locked in. Don't chase the bounce in precious metals until margin requirements reset to pre-event levels. That's your signal that the suppression window has closed. Track the Treasury International Capital reports weekly because they show you whether foreign buyers are returning or retreating. The data lags by 6 weeks, but the trend tells you if this was a one-time liquidity grab or the start of a sustained financing problem. Assume that official inflation data lags the actual cost pressure you're experiencing by at least 2 quarters. The components they remove from core measurements are the ones hitting household budgets hardest. Treat the gold to silver ratio as the signal, not the headline price. When that ratio compresses below 70, it means industrial demand is overtaking financial demand, and that's a leading indicator for manufacturing activity. When it expands above 85, it means fear is concentrating in monetary metals, and that precedes credit stress. Keep optionality. This environment punishes conviction in a single asset class because the rules are being rewritten in real time through administrative levers that don't require legislative approval. The question nobody is asking publicly is whether this margin rule adjustment was coordinated with Treasury issuance timing or whether it was coincidence. The gap between those two explanations is the gap between market mechanics and policy intervention. If it was coordinated, then every future debt rollover window becomes a potential suppression event for competing assets. If it was coincidence, then the next move in gold is purely technical and the dip gets bought by the same players who sold it. But the evidence points toward coordination. The timing is too precise. The lack of a macroeconomic catalyst is too clean. The simultaneous move in Treasury yields is too aligned. And the absence of any official commentary from the Federal Reserve or the Treasury Department is too deliberate. Silence is a form of confirmation when the market moves this violently without explanation. What this creates is a two-tier system. The paper market for gold and silver, which is where price discovery happens for most participants, is now a managed market. The physical market, which is where sovereigns and high net worth buyers operate, is separating from that managed price. The spread between the two is the risk premium for trusting the system. That spread is widening. In 2008, when Lehman collapsed, gold spiked because it was the only asset without counterparty risk. In 2020, when the pandemic hit, gold spiked again for the same reason. But in both cases, the spike happened after the credit event, not before. What's different now is that gold got suppressed before the credit event, which means the system is trying to prevent the flight to safety before the safety is needed. That's a defensive posture that reveals more about systemic fragility than any official statement ever could. The $6 trillion that moved out of precious metals didn't disappear. It moved into short-duration government debt and money market funds yielding 5%. That's where the capital is being steered. The question is whether it stays there voluntarily or whether it gets trapped there through progressive capital controls, tax policy shifts, or further margin adjustments on alternative assets. The incentive structure is clear. The execution timeline is already in motion. What remains unclear is how long the paper price can stay disconnected from physical demand before the pricing mechanism breaks entirely. The unanswered question is not whether they can maintain the suppression. It's whether they can maintain it without breaking the pricing system entirely. Every margin adjustment, every liquidity extraction, every coordinated move through clearing rules tightens the gap between control and collapse. The paper market can only diverge from physical demand for so long before one of two things happens. Either the paper market loses credibility and participants exit entirely, or the physical market gets restricted through policy intervention that hasn't been announced yet. Both outcomes end the same way. The pricing mechanism stops reflecting supply and demand and starts reflecting political necessity. When that happens, the assets you hold stop being valued by markets and start being valued by decree. The Treasury needs $600 billion in net new borrowing before September. Gold and silver needed to be neutralized before that issuance cycle began. The margin call was the tool. The debt rollover was the motive. The timing was the confirmation. What comes next isn't a recovery. It's a recalibration of what gets protected and what gets sacrificed. They didn't crash gold and silver. They cleared the path.